All right, it looks like we're live. Welcome, everyone. On behalf of Brian and myself, thanks for joining us today. I'm sure you're all busy at work or at home at work. I want to I want to thank Connor O'Brien, CEO of O'Shares, and Kevin O'Leary, Mr. Wonderful himself, for joining us today for this conversation. So hopefully you find it educational and informative and take some nice things away from it. So why don't maybe we start with Connor? Do you want to just give a quick snippet of O'Shares and Kevin and how you guys work together, and we can kind of go down the road from there?
Yeah, for sure. Thanks very much, Brian and Jeff, and all those who are with us this morning. And Kevin, I guess you made it to Miami and you've got your studio set up. Good to see. So O'Shares, just so people know, is a company that have created a set of ETFs. They're designed in a way that is different than the generic ETFs, and Jeff and Brian use some of them, I understand. They're designed in a way where they're financial measurements to determine which stocks make it into OUSA for large cap, OUSM for small and mid cap, OGIG for global internet and e-commerce, and OEUR for Europe. Basically, the metrics are designed to exclude stocks that have weak financial fundamentals. Companies that have low profitability, bad balance sheets, they get excluded. So that's about all I need to really say about those, although Kevin does use them in his family trust and for his personal wealth management as well. And so a lot of the design criteria reflect Kevin's philosophy of essentially a conservative approach to equity investing. And so, Kevin, I don't know if you'd like to add a little bit about ETFs. Why did you decide to all of a sudden gradually like ETFs more and more? Maybe you could just talk about that a little bit, Kevin, because I think some people know a little bit about ETFs, some know a lot. Maybe just add your perspective why you like ETFs.
Well, I think one of the benefits of the structure of ETFs, particularly for preservation of wealth mandates, long-term investment mandates, you made reference to my family trust. For the equity side, we do use ETFs only. First of all, total transparency, in most cases, total liquidity, but above all, incredibly good tax efficiency. The rebalancing that occurs in ETFs are done in a way that really avoids the tragedy that occurred in mutual funds decades ago, when all of a sudden you would be facing capital gains taxes on gains you never, depending on when you entered the fund, you never participated in. That's a flaw in that structure. It remains so, and that's why ETFs, I think, continue to become the preference in terms of how people wade into equities, and certainly for me, that's been the case.
It's something for sure Brian and Jeff know very well, and their clients probably appreciate learning a bit more about. So let's get to the topics at the top of everybody's mind. 2021 is a brand new year, but somehow it feels like it's starting off with some things carried over from last year. Some things are changing. Coronavirus, not gone yet. New administration essentially confirmed yesterday through that crazy scene in Washington, and inauguration coming in 2 weeks. Let's talk first about the health side of it. What do you see going on the pandemic globally and in the U.S.? What do you see as the outlook for the next, let's call it, balance of this year, as the gradual, rapid, or what kind of return to a normal world?
Yeah, it's a timely question, because I just arrived back to my Miami home. I haven't been here since last June, and I'm going to be staying here again till June. And I immediately called my doctor yesterday to come and test me for COVID. And it was very, very difficult to get tested a year ago. I'm trying to look at it from the sides of vaccine and testing. I got tested yesterday at this time. I have my results back last night. I'm negative, thank goodness. But he also gave me 12 self-tests, which are 96% accurate. So from the testing point of view, which matters a lot, it's opening up, which is great. Vaccine, I asked him, when am I going to get vaccinated? And he said, look, we're behind here in Miami-Dade County by about 60% of what our goal was supposed to be. And it's still only at the hospital here. Although, the local Walgreens is saying that probably within 3 weeks, we'll start taking appointments. And it's all, so I think the anticipation of vaccinating 20 million people, at least giving 20 million shots prior to year end, we all know that didn't happen. But I think this is kind of a situation where it's going to be like a hockey stick curve. I fully anticipate to be vaccinated, within the next 5 weeks. Here's an interesting perspective from Hollywood. Shark Tank started casting yesterday morning, all virtually, and they have told all the candidates, of which there are hundreds of thousands interested in getting on this season 13, that they will not be able to present unless they're vaccinated with a vaccination passport. So there you're seeing the private sector starting to look forward in terms of how they're going to use the vaccination to make business decisions. So they only want people that are willing to A, get vaccinated, B, show negative, even when they're tested before they come on the Sony lot. But I think this is going to happen throughout the economy. The airlines, the restaurants, the bowling alleys, the sports venues, so I'm very optimistic that sort of by maybe middle of summer, maybe end of August, we'll have 50% of the population that wants to be vaccinated, inoculated. And then we'll go into the back end of the year trying to get the other 50% on board.
That's actually not a bad outlook. It's been a long grind since March of last year, and we're more than halfway through it, if your numbers are approximately right. So let's talk about Washington. Yesterday was a bit of a crazy scene, but let's not get distracted by just one day. We got the Fed, and we've got a new administration in 2 weeks. Assume that we get to that Jan 20th date, and we got Congress set up the way it now looks like it's going to be set up. What's your outlook for the next 2 years with that setup in Washington, that Fed, that administration, the White House, and then Congress, fully Democrat?
Yeah, I've had a few of those questions this morning. I mean, how could the market hit new highs when there's chaos on the streets in Washington? That was very tragic what happened yesterday, and everybody knows the story. And I guess the best way to look at it is what policies, because if you're an investor, you have to think about policy. What significant policy changes will occur in the next 24 months that would make you change your investment decisions? Well, we know now that with certainty that there'll be a very pro-bias, more stimulus, particularly towards infrastructure. That is a good thing for investors, no question about it. We know with certainty there'll be a new administration, and some of the craziness that's been going on in Washington will go away in the next 15 days, and that's a good thing. Certainty is a good thing. I think the bigger challenge for investors, and what I look at every morning is the 10-year, and I look at the credit markets in Europe earlier in the morning. You really have to start thinking about inflation and your allocation to fixed income. People are talking about, the 10-year going significantly past 1%, maybe to, 1.3 or whatever. I actually think it's going to see 2% this year. And that will be as a result of an extraordinarily strong economy in the back end of the year. Now, if you are sitting with a whole bunch of government bonds or a major allocation of fixed income, this is going to be one of the worst years you've ever had, in my view. This is a personal opinion. And certainly when we talk about what I'm doing with my own, family trusts and my own net worth, is I am making a conscious decision to significantly reduce my exposure to fixed income. Any long duration fixed income, I don't want to own during this transition to higher rates. And so really what I used to be 50-50, and I think many people think that's a conservative structure, 50 fixed income, 50 equities. I'm 70% equities now, and I've used, and you made reference, but I use products like our own in O-Shares, OUSM for my mid caps. They provide a distribution. They're the highest quality of the Russell 2000, same OUSA, the highest quality of the S&P. And I'm now exposing to Europe as well through OEUR. And of course, OGIG is my growth in O-Shares. So I own all the products that we've developed indices for. But I would say one thing for the domestic holdings, the OUSM and the OUSA, you have to start thinking about owning companies that provide profit distributions through dividends, which I think is good, that have strong balance sheets, but also have pricing power in inflationary times. Because inflation, going from 1% to 2% on the 10-year is actually a very bullish thing for corporations. It's showing economic activity expanding. The cost of money is going to get more expensive, but at the same time, pricing power. until the 10 years at 3%, equities is where I'm going to be, and I think that's for definitely the next 36 months.
Yeah, if you do the math on the 10-year, maybe Jeff and Brian don't own any U.S. government 10-years for clients specifically, but the math's kind of interesting. If you get that move that you just described, if it all happened in one day, the value of that 10-year bond that you owned before the move and after the move would decline by about 14%, which is not what people expect out of a government bond.
Yeah.
Never happens in one day. It'll take months, but the point is you're grinding your portfolio return, you're dragging your portfolio return back.
Where do you
move to equity sounds it sounds like a trend that is going to catch on through the course of the year. Jeff, Brian, maybe turn it over to you.
Connor and Brian, while we're on the topic, you were discussing equities versus fixed income. Obviously, the U.S. markets have dominated the last decade, mostly because of 5 or 6 companies. Do you see, or are you shifting any of your capital overseas using something like OEUR versus focusing more here domestically? Because of maybe reversion to the mean, or just the fact that they have underperformed so much versus the U.S.?
Combination of all of the above. I mean, you're astute to point out the underperformance, but you got to remember OEUR is the top 50 European companies, of which in most cases up to half or even a majority of their sales are in the U.S. The Nestle's, the Roches of the world, American Tobacco, all those companies that are very strong balance sheets that have been sitting underperforming, and yet they have gotten stronger and stronger in terms of their revenue. But also having exposure to the Swiss franc, the euro, and the British pound has not been a bad thing for the last 90 days. And as we continue to print money and maybe another infrastructure bill for a couple of trillion, we'll see what happens. It's unless you want something very non-traditional. I mean, I own $100 worth of Bitcoin just because it's amusing, but I can't put a significant part of my net worth into that to protect against inflation. I'd rather own something that is a long tried and proven generator of wealth, which would be a company. And so I want to own Nestle, I want to own Roche, and so I don't think a 15 to 20% allocation to Europe for the next 36 months is a bad thing, while you're picking up a strong distribution of close to 2%, or in some cases over 2%. And remember, I'm in the boat where I have to distribute 6% a year from my trust for the charities and supporting the various initiatives that they signed up to do decades ago. And so, I have to be conservative, but I also have to distribute. So my bogey is 6%. So if I can pick up 2% in distribution and, hopefully 4% in capital gains, I'm happy. And we've been doing way better than that, obviously. But the economy, the reason the markets are at new highs is the economy is coming out of this pandemic with a new efficiency through digitization. And many of the companies that provide for that are found in the indice OGIG. And that is not going to stop. And people think these are stay-at-home stocks. They're not. They are work anywhere stocks. And I have the privilege of seeing budgets now for Q1 and Q2 of over 35 private companies that I have ownership in. And we are significantly reducing our exposure to corporate headquarter costs. So 15% of our staff doesn't want to come back. And the one that's really blown my mind is the reduction in business travel and entertainment, 20 to 50% reduction. So that's happening right through the S&P 500. And that's why you're going to see an enhancement in earnings and in gross margins and in productivity that we really haven't focused on yet. So I don't think the markets are too expensive. I don't think the trends change in digitization. And once we stabilize Washington, which will happen in a couple of weeks, I think you're going to be very impressed with the power of the economy. And I'm extremely bullish, but not for fixed income. That this is going to be a time, for the first time in 25 years, where you're going to be punished for going long duration, in my opinion.
Jeff, you asked about Europe and international. There's 2 topics on that. One, just to finish on Europe. The Brexit deal finally got resolved. That is a gray cloud that's basically cleared. So that's a positive. The stocks in the sectors Kevin mentioned, Roche, Nestle, names people know. If you look sector by sector, Europe is cheaper than the very comparable stocks in the US, and much more so than usual. So it's about 2 full valuation turns on a PE basis of, let's call it, reversion to the mean, to normal valuation relationship, US to Europe. 2 full turns to be realized by investors who own Europe before that move happens. If people wait for Europe to outperform, then they're not going to get that outperformance. You got to own it before it actually does that performance. And so I know you've already been, you're ahead of that. So that's, I think, a smart move. And OUR is the 50, not just largest companies in Europe, they're 50 very large companies, but they're those that are selected using the criteria I mentioned in the intro comments. Companies that have very strong profitability, very strong balance sheets, etc. So that's what I wanted to just add on Europe. And I think that Brexit cloud having cleared is quite important. It's been lingering around Europe for a couple of years. The other international question, well, actually, Europe, just finish on that currency bit. If the US dollar weakens, OUR is a nice investment to own as a counterbalance to that as well, because it's a basket of all the other non-USD currencies that are Europe-based. The other one is China, and Kevin got some kind of real-world, frustrating, entertaining kind of comments, both entertaining and frustrating when everybody hears these, of how China has been ripping off his companies. And this is not just generic China bashing. This is taking a look under the hood, the view that you get when you own 30 plus private companies and you see them getting ripped off by China. So I've kind of teed it up, Kevin. Why don't you just talk about the kind of China policies you've been living with and what you'd like to see happen with the new administration?
Yeah, I've been doing business in China for over 20 years through multiple administrations. And the typical model was that you send your molds over to China, and we have many, many, many examples of this. And we would manufacture there. And as soon as the product hit 5 million in sales stateside, which sort of signals you've got a hit on your hands, you can watch it occur on Amazon or on the other online sites. We would start to see knockoffs of our products on Alibaba and JD.com and other platforms, not just domestically, and they were domestic, but also internationally. And the star rating system on Amazon, the knockoffs would hit us, and there would be 10,000 reviews on the knockoffs at a 30% less. And if you opened it up, which no one ever does, and actually read the reviews, they were in broken English, and they were published in a sweatshop somewhere in Asia. And so there's bots doing that. And luckily, in the case of Amazon, we do so much business with them across this portfolio of private companies that we have a relationship person that can take down a knockoff by just proving our rights to the trademark or the IP technology. But we can't do that with Alibaba. And so there is the bigger problem with this is for the S&P 500 and me and everybody else that's doing business is 20 years ago, it didn't matter as much because we didn't care that the domestic market was ripping us off in China. It was small, but today their middle class is one of the largest and fastest growing on earth. And I figure in the case of, a product like Benji Lock or some of the products that I have that are global, that I'm losing 15% of sales to the Chinese market. I don't have access to their courts to litigate my IP, and I don't have access to their markets. And my molds, in many cases, are being used at night when my branded product isn't being made. They're knocking it off with my molds. Now, I've sat through many administrations, regardless of political sway. I don't care what side of the aisle you're on this. Everything we've done hasn't worked. It just hasn't worked. We've gone and tried to rally other countries. We've gone to the world authorities and tried to get some compliance through that. It just doesn't work. What the Chinese understand, in my view, my point of view is my point of view, so I'm not saying this should be policy, but they understand the stick. They understand the stick. And what I would like to do is I'm for delisting all their companies. I am for not allowing them access to our courts so that we can rip them off in our domestic market. Now, this may sound draconian, but I guarantee you, if you go down that path, this will be resolved. And that's what we need. And so, I understand yesterday was a tragedy towards the Trump legacy, but there were some policies by his administration and good people in that administration that were putting forward the Kudlows of the world and everybody else that understood this dilemma in China. And I'm hoping that the Biden administration will pick up on this work and not just reverse the decisions made. You saw today they may delist Alibaba and Tencent and others. It's highly unlikely to occur, but the threat of it is going to wake them up. And that's what is going to be required, because if we could all of a sudden have a level playing field, the S&P earnings could go up 6-7%. getting access in a real way to the Chinese market and protecting our IP. So I'm a bit of having lived through it, a little more hawkish than others.
Yeah, some of the research written about Biden's policy on China is that he's also going to be planning to be tough on China with a different approach, which is multilateral. So instead of just him versus China, his plan apparently is to try to get the rest of the G7 countries to go along with the tough on China policies. Australia has kind of gone on their own as well, and now they're suffering a little bit of consequence, but so what? They'll sell their stuff to somebody else because they've got raw materials that basically have a global market. So I think Biden's approach might actually be stronger than Trump's, because when you put all of G7 countries together, the economic weight is much more than double the scale of just the U.S. on its own. So moving on from China, where I think we're all probably in agreement that we'd like to see some of those changes you talked about, let's go back to last year, and I think this relates to next year. And next time there is an equity market shock, it's going to happen again. It happens every year on average. A minus 15% event occurs. The market always has come back every single time. Last year, the shock in, let's call it, when the shutdown occurred, was about a 34% drop on major markets. Jeff and Brian asked us to ask you your comments. Were you scared? Were you surprised when the market came ripping back? What are your comments? How did you live through those weeks in the markets? And what is your comment on how fast it all came back?
Well, my attitude about this may be a little different than others, but what I've learned, and let's go back to my problem of having to distribute 6%. So here I am. I remember last March being exactly where I am sitting today as we were shutting down the economy, and the volatility, as you recall, we were getting 1,100 point days. So I would, at 4 o'clock, the market would close. I would go out onto the balcony with a glass of Chardonnay, which is a tradition for me, and I'd be down millions of dollars. And then the next day, we'd go up 800 points, and I'd be back up millions of dollars. And in the calendar year 2020, the majority of the returns came in a handful of days with these extraordinary swings. And so the lesson for the investor and for the advisor has to be, it is impossible to time the market. It is simply impossible. And you don't know. You would have thought yesterday, watching, the Senate being breached, that you would have had a very down day, but that's not what happened, because the market is looking past that. And we have tremendous liquidity in the system, not just domestically, but globally. The ECB, in addition to the Fed and policy in the US, is going to be very accommodative for the next 12 months. And so my point is, you can't time it, and I don't try anymore. I used to when I was a lot younger and lost a lot of money doing that. And so I'm more about allocation from asset class. And I spoke earlier about this shift from 50-50 to 70-30. I'm 70% equities. That's the most equities I've ever owned in my life as a percentage of my net worth. I'm very comfortable with it. I might even increase it because I'm pretty sure that we're going to get some inflation in the back end of this year. It's almost, in my view, assured with this much fiscal stimulus coming. And it isn't necessarily a bad thing. I mean, so at the end of the day, I stay my allocation. And as a matter of fact, having reduced my exposure to some sectors that I think won't perform as, for example, commercial real estate used to be 31% of my portfolio. Now it's 8%. So I'm sitting on a very large amount of cash to deploy, and it's going to be going into equities.
Now, when you talk about real estate from a commercial standpoint, was that eliminating, trimming, or you're just not allocating new funds to it anymore? Like, did you have exposure previously to commercial, and did you just trim it, or is it just how are you doing?
Well, I have been, I have been involved in investing in real estate for 30 years, and it's the core, both residential, multifamily, storage, climate-controlled storage, hotels, AAA office in Boston and New York. Here's my problem right now, and I'm not saying it's a forever problem, but here I am negotiating with REITs in New York State in Florida, in Texas, and in California. The nexus of where my HQs are in my private portfolio of companies that are across the sector. I've got companies that manufacture, I mentioned, Benji locks. So we manufacture locks, and we have a gym equipment company in Fargo. We've got companies in Chicago, Miami, et cetera, et cetera. Across the board in developing the budgets for Q1, Q2, because these are private companies, we don't mark to market them on share price. We mark to market discounted cash flows. So we're very close to the top line each week and the bottom line of free cash flow. And we saw obviously in March most of them went negative cash flow, and now 80% are back ahead of forecast for Q1 in 2021. And that happened through this digital pivot I referenced earlier. But the point is, every single one of them has found this extraordinary outcome where people involved in accounting, compliance, and logistics simply don't want to come back to their cubicles in the office. And they don't want to. And they are either living in the burbs, raising kids, taking care of elderly parents, or they don't want to commute. Whatever the reason is, they want to be given an option to work at home, as they have been successfully for almost a year. And this is not just me. This is happening across corporate America, particularly in tech firms and every other kind of firm. And so as a result, here I am, in some cases, litigating landlords. And I'm also an owner of the building. Well, that doesn't make sense. If I have liquidity, I can get out. I have gotten out. And I'm not saying I won't go back in. But let me, for example, Bed Bath & Beyond closed 200 stores last year. Huge customer of mine, and yet their digital sales are up 75%. So what happens to those stores? Well, they're not going to be retail anymore. They're going to be probably climate controlled pick and pack robotics supply locations for the suburbs that they're in, or they'll be turned into condominiums or some other use. But I just think during this adjustment period for commercial real estate, I'd like to reduce my exposure where I have liquidity to do so and look at new opportunities. Movie theater chains. I don't know if you heard from AMC's CEO yesterday when he made comments. I don't think that those are going to come back because of the pandemic. I think people's preferences on how they consume entertainment have changed permanently. So those are going to be reduced assets in terms of value forever. I think maybe they should be converted into cloud kitchens because they're in good locations. But those will be the opportunities I'll invest in to convert use. But right now, if you had let's say I had a hotel in Boston at a 5 cap, I think that thing's going to trade at a 7 cap when this is all over, or maybe a 4.5 cap 70-story building in New York that was a 4.5 cap. Maybe that's a 6 cap. I just don't know. And meanwhile, I can invest in other companies where I feel much more comfortable on the equity side. So yeah, I am making a personal decision in commercial real estate. Now that's not the case in residential. Residential has been very strong and I am exposed there. And, I'm just saying from my perspective of a readjustment, I'd rather be less exposed than more exposed.
Are you keeping a certain percentage on the sidelines in cash? I know you said you had cash on the sidelines to allocate. How long do you keep money on the sidelines, or how do you deploy it into investment?
Well, I have an extraordinary large percentage right now because of the real estate move, and because some of those were relatively illiquid, and I had to wait to get the cash, which came at Q4. I am now redeploying that cash. I like to layer in, obviously, and I was actually having this discussion with Connor, last week about Europe and just thinking through. What I like to do, and the reason I'm a co-owner of O Shares is I like to index. I like to, when there's a theme that emerges, as we found last year in technology or the year before, and the OGIG index was developed. That's up. That last year was up over 100%. But those were all the companies I was using to digitize my private companies, and we were major users of DocuSign and Zoom, and still are, and Wix.com and CrowdStrike and all of these things that provide us digitization. So for me, it's finding investment themes and then seeing if our team can develop an index, which we do quite successfully, and then invest in that. stock picking, I'm not against it, but it's not easy. Themes tend to work. OGIG's a good example. And OGIG way outperformed the QQQs. It way outperformed the S&P tech sector, because those were the companies that actually were providing the engine, many of which names people have never heard of. I encourage everybody to go look at it and look at the names. You'll recognize the FANGs, but you won't recognize anything else. And yet the FANGs held back the performance of OGIG. They were the worst performing. And so there's many other companies that one could own in an index. So yeah, but what you won't see me doing in this next year will be putting money into fixed income. That ain't going to happen because I'm of the opinion that 10-year is going to be 2% by the end of the year, and it's many grown men are going to weep on the mark-to-market correction on that.
Let's go through some of the other big sectors. Just pick on some that you think are going to be big winners, big losers, and blend into that market valuations. I mean, tech stocks have never been so expensive. So maybe we start with that sector. It's the biggest. It's the most expensive it's ever been.
I understand people say that, but my allocation to tech isn't changing. It's staying the same. They are growing very, very quickly in a very low interest rate environment. Even if the 10-year goes to 2%, it's still significantly below 3%. And so they are going to continue we always have tech correction and then it comes back. I don't think that's going to change. And I know there's a lot of, bashing on social media companies, but the truth is the majority of the market cap is around e-commerce that I'm talking about. When we talk about an index like OGIG, and e-commerce is not going away. In fact, it's going to grow and continue to grow for large and small companies alike. So I want to be exposed to that. Healthcare, some people think Dems will bash healthcare. I don't think so. The mandate for Biden for his first 100 days, his number one job is vaccines. He will be so myopically focused on rolling that out for the first 24 months of his term, is to get the economy back, get his infrastructure bill done in the first 2 years, and get everybody inoculated. He's busy. So I don't think he's going to be spending his time bashing business or, raising taxes at a time when the economy still has 10 million people unemployed. All that stuff is going to keep him myopically focused on the things that matter to us as investors, and I think that's going to be a good outcome. And then what I think is going to happen, because I'm a bit of a policy wonk, is that he will continue to lose seats in the House. And that happens to every incumbent. It happened to Trump. It'll happen to him. They'll continue to lose seats in the House, and that will keep our balance the way we want. I mean, it's obviously it's a very tight balance now, so I don't think we're going to see any crazy green deals or any of that stuff. And so I'm pretty optimistic on some, basically three sectors. Anything to do with consumer, healthcare I still like a lot, because we're going to repatriate all of our medical supplies, and there won't be any just-in-time inventory metric in healthcare. It's going to be just in case, because we don't know what COVID-20 or 21 is going to look like, or new strains and all that stuff. So we're going to bring all that back to Puerto Rico, North America, Canada, Mexico. Big investment opportunities there. Everybody's very health conscious. And then, of course, technology and the consumer. So my focus is three sectors: healthcare, technology, and the consumer. And I think for big oil, which looks like such a big opportunity, was always a huge holding for me. What I worry about there, even with oil moving up and the Saudis doing their thing this week, I can't find I get to talk to a lot of pension managers and sovereign wealth managers in what I do with my day. They are all moving away from even talking about hydrocarbons. And so the incremental buyer of the Chevron and the Exxon and the Schlumberger should always be the sovereign and the institutional, the CalPER or whatever, but they're not there. And so if you're going to get into those stocks and think you're going to get capital appreciation or PE expansion, I don't think you are. I think that sector is going to continue to underperform because the incremental buyer is going away. Now, that may sound counterintuitive, but I don't think so. And I think it's a value trap. You got to be very careful. So, again, if you're not going to do energy, where does that take you? And those are just some random thoughts.
Yeah, those are definitely good touch on the various sectors. So large cap, small cap, value, growth. some investment themes, and then we're going to get to some fun topics that Jeff and Brian put on the roster. So what are your thoughts about large cap and small cap? Small cap actually outperformed last year. It's outperformed in the last few days. What are your thoughts on what people should be doing to allocate to the small cap space?
Well, I have never owned the Russell 2000 because, the majority of the companies don't make any money. And just as a philosophy and just what I own, I don't want to speculate on profitability. So I just simply don't want to own companies that aren't profitable, generally speaking. And so for small cap, I want to avoid that. Another metric I care a lot about, it's old school, it's almost Charlie Mungerish, it's return on assets. I mean, I don't want to own companies that have virtually no return on their assets, or 1% return when it should be more like 11 to 15. So you find a lot of that problem in the Russell 2000. So I prefer to own a subset of the Russell 2000, which I do now own, which is 20% of my holdings is OUSM. I know I'm talking my own book, but it's an index designed to own profitable small and mid cap companies. And that's my holdings because it, again, provides a distribution. These are profitable companies that are small cap, don't really have much exposure to the whole China problem because they're domestic in nature, and yet have done very, very well of late because people are starting to look for value and growth at the same time. And those companies are. So I'd urge people to look at OUSM, and they'll find the companies within the Russell 2000 that actually make money and have a return on asset. And excluding REITs, because I've already told you why I don't want to own REITs right now in commercial real estate. But I think it's a really interesting way to play that space, and that's how I do it.
And just so people, often the word small makes people think that they're small companies. They're average market capitalization of $5 billion. So they're actually pretty good sized companies. If anyone on this call owns a $5 billion company, they know that it's a good sized company. So away from investment markets now, let's just talk briefly about business owners and your just top few thoughts for business owners you can share with them, strategies for the next 1, 2, 3 years. You've got an ownership stake in over 30 private companies, so you've got a fantastic window on so many strategies, so many CEOs and management teams. What are they doing? What do you take away from that you would share with any business owners on this call?
Yeah, I've had a remarkable journey since last March through these private companies, and the ones that came out of this alive and successful and ahead of schedule on free cash flow have all made the digital pivot. So I say to every business owner, understanding social media, understanding digital marketing, understanding customer acquisition, understanding direct-to-consumer margins, which are very, very, very attractive. Shopify has 1 million businesses on it now. It's the anti-Amazon. I mean, we do a lot of business with Amazon, but every single one of my companies now has a Shopify license. And we sell direct to consumers because we're replacing what we've lost in retail. And many, many stores that we're not reopening ever. And so I think small business owners have to understand that someone in their team should be focusing on understanding, digitizing their business, servicing their customers digitally, supporting them with customer service digitally, acquiring them digitally, selling to them direct, understanding inventory control that way or service that way. And in fact, I will not invest anymore in companies that tell me their strategy is 50% retail. I know that's not going to work out for them. And I think over time, I'm looking for those digital skills now in a way that I never have before. So that's what I talk to small business owners about.
That sounds like go direct to the customer using e-commerce, reduce your retail footprint, reduce your costs, but get closer to your customer. So a lot of people on this call probably have kids that are college age, entering college, exiting college. In the past, you had advice to people that the only thing to tell their kids to do is engineering, engineering, engineering. I know that's changed. Talk briefly about that. What kind of advice would you give to your kids if they were 10, 12, 15 years old going into college?
Yeah, I've had a bias for the last decade. I spent a fair amount of my time guest lecturing in places like MIT and Temple, Harvard, Notre Dame. And I enjoy those sessions with business grads and graduating cohorts of engineers. Now, I've always liked engineers because a third of the class generally starts a company. They're very entrepreneurial in nature. And I've always told college kids when I can speak to them, or in high schools. As Sharks, we visit a lot of high schools. And when I tell kids, look, there's three things you should focus on, or at least I used to. I'd say, if you're going to invest $60,000 of your parents' money, or you're going to borrow it for college, number one, engineering, number two, engineering, and number three, engineering. And if you want to back up, go with engineering. And because you're going to get a job. I don't care what engineering discipline, robotics, it doesn't matter. But in this last year, because I have an engineer, a child, I've got a son who's an engineer, electrical engineer. He's on his way to work at Tesla. But I also have a daughter who's in the arts. And I've always said, she went to Tisch in New York City. She lives there. I look at my budget for Q1, Q2 in my private companies now. And where are we spending more money than we ever have before? Social media, video production, re-photographing all of our products and services, redeveloping their websites. We're paying copywriters to republish content. I just looked at a huge budget for animation. The whole area of the arts and digitization there are no starving artists anymore. If you want a job and you're a good artist, you're not starving. I'm paying video editors in India and Israel and England and Hawaii, and just to get capacity to shoot. We have 38 terabytes of video from last year alone, shot in 4K for all of our products and services, and we're screaming to get people to edit it and cut it to 59 seconds, to 29 seconds, to whatever it is that we have to test on Instagram, YouTube, LinkedIn, yada, 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 yada. All of this stuff that you have to do. There's no option. And so I'm wrong. Engineering is not the only place you can get a job. If you're a great copywriter, you're a great editor, you're a videographer, animator, you're going to make a ton of dough. And and the reason is I'm one of them. I'm paying you because I need you, and I have to find you, and it's an amazing turnaround.
Yeah, definitely transformation and the kind of advice you've been giving people. So Jeff and Brian, I know you've got some questions on wine, on watches. I'll let you turn it over to you so you can fire those questions and have that conversation with Kevin.
All right, Kevin. I know you like a nice glass of Chardonnay on your patio when the market closes. Tell us about your wines and what you're doing now.
Yeah, we've had a tough year with the fires. I have a very large wine business now, but it really speaks to what I talked about in digitization. My first 5 years, I made no money. Now, that old joke, how do you turn $1 billion into $1 million? Get in the wine business. And there's a lot of millionaires in the wine business that used to be a lot richer. But what happened a few years ago was that the laws changed in 48 states, and we can now ship direct from our wineries in California, Napa, Sonoma, and Walla Walla Valley, Washington State. The case of wine is 39 pounds, and so we can ship it direct to you. And the logistics are complicated, but I partnered up with QVC, which has 6.2 million people a minute watching, and I've become the largest purveyor of wine on QVC, and I'm in partnership with them. So what I learned over the years is that 97% of wine in America is sold for under $15 a bottle. So you have to be able to make great wine at low prices, but you have to have the logistics to ship it. And so we've turned that business into a huge business, very profitable. And I'm going to ship about 150,000 cases this year. Most of the wineries, these high-end wineries are lucky to ship 25,000, 20,000, sometimes 5,000. 125,000 cases is a lot of wine, and maybe more. And you can go to qvc.com. And what I like, even I buy my wine, not from me, I buy it from QVC because they pay for the shipping. Anyways, that's, I love the wine business.
The last time we had a call, you and I and Connor, before your watch went to auction for that fundraiser. And I've watched a bunch of videos on YouTube. I've kind of gone down that rabbit hole. So tell us about your passion for watches. What are you wearing today, and what are your thoughts on it as an investment and as a hobby?
Yeah, I think because we're all investors here, it's a very interesting asset class. At first, I was, my stepfather is a Swiss citizen, and my first dad died when I was very young. I think I was 10 years old. And so he's been my father my whole life, more or less. But he's very passionate about wine and watches as a Swiss citizen. And so I've spent many, many summers in Geneva. And he took me through the famous Maisons when I was a teen. I bought my first fine timepiece when I think I was 18 years old. I have a very, very extensive collection today, and I mark to market it. There's many technologies. One of them, for those that are interested, they're listening, is Chrono 24. It's an app that's developed AI for watches. You can just take your phone and put it in front of the dial of your watch. It'll find it for you and give it the last trading price worldwide last night. So you can tell as you build your collection on that app, you can mark to market the value of it. And so, the traditional pieces that people think of are Rolex, Patek Philippe, and Audemars Piguet. Those are, of course, the classic three horsemen of the Swiss watch industry. But the truth is about the watch industry, it was actually founded in Japan. Grand Seiko, not Seiko, Grand Seiko has some of the best watchmakers on earth. It's making a resurgence back in the 70s when the Swiss invited the Japanese to come and compete around accuracy. And they started introducing their Grand Seiko movements against the Rolexes, the Pateks, and the APs. They kicked their butts every time, not by a little amount, by a lot. And in fact, they today still have the most accurate timepieces at the most affordable prices. So I'm a big proponent. I have many Grand Seikos, and the Swiss canceled those contests. They don't have them anymore because they can't beat the Japanese. They're the best watchmakers in the world, mechanical watches, I might add. And then the Germans, Lange, very big. I have, very interesting pieces from there. But the point is, I view it as an asset class. I'm up 113% year over year. I have more watches than I could wear. If I wore 5 a day, I couldn't get through them in a month. And so, my wife just goes out of her mind when I come in with another watch. She says, why? What is the problem with you? Why could you possibly need that? And I show her the mark to market. And she says, that's all BS. You're doing that just to make yourself feel better. But my son looks at this and says, Dad, what's going to happen to these watches after you're no longer with us? I said, well, Trevor, I'm burying these watches with me. They're being put in the coffin. So you're not going to get any of these. I'm going to need them in the afterlife. But the point is, they're valuable. They are an asset class like art is, like sculptures are. And I buy today only one of a kinds, or one of 30. I just took delivery. I could talk watches for hours, but when Beirut had their bombing tragedy, IWC, the famous company in Switzerland that makes pilots' watches, made 30 watches to help offset the cost, and all of the proceeds of the sales of those watches go to the relief funds there. 30 pieces with the Beirut green on the dial and a Beirut cedar etched in the back. They were only sold in Beirut and in the United Arab Emirates. Of course, they were snapped up in 4 seconds. Now, my mother was Lebanese, and so I appealed to the royal family of the UAE to see if they, and this is the watch community, the way the watch world works. People know I'm a huge collector. The largest collectors on earth are royal members of the Saudi and UAE families. And I said, look, guys, I would never ask this favor, but for me, the emotional connection to that watch is huge. Is there any way that you could help me acquire one of these? And they petitioned the CEO of IWC, and I, in fact, received it yesterday here in Miami. I'm going to be doing some social media with it. It's the only one, I think, in North America. But they gifted it to me after somebody in the royal family bought it, and I immediately responded with a gift back to them, as you should in that culture. But this is the kind of thing I love, I'm passionate about, and now I can get focused with my millions of social media followers about the tragedy in Beirut and thank the CEO of ICW, and I have a watch to die for. When you see this piece, it would knock your socks off.
Yeah.
So Kevin, I was an engineer before becoming an advisor. So thank you for your comments about engineering.
Well, it looked like it worked out for you, right? You're doing okay. That's my point.
Right. I was wondering, another aspect of the show, Shark Tank. Any funny stories that come to mind to share with the group?
Yeah, I would have never thought that Shark Tank could go this long and become the iconic platform it's become. We've helped so many entrepreneurs build businesses. because basically the secret sauce of Shark Tank is it's an 8-minute infomercial. So your customer acquisition costs go to zero, and that's the number one cost of any startup in America today. So we create a lot of success. I'm very proud of the work I do there. We now have a second generation of people that grew up watching Shark Tank, now are entrepreneurs on Shark Tank. They say, well, I was 7 years old and I used to watch the show, and I said one day I'd get there. We have plenty of people like that. It's a very interesting platform, but I will say this: when we get there and we shoot it, and because I've been working with these people now for over a decade, we're very competitive. And it's a real strategy, because I know with my team I can take a product that's doing $1 million in sales and turn it into $5 million in sales in 90 days. I can make a lot of money doing that. I can help build that company, and I have. And so it's like that cast of Friends. People always ask me, what's it like to work with Cuban? What about Damon, et cetera? I always, when I talk about Shark Tank, I always say the only reason Barbara Corcoran gets to the set on time is I buy her a new broom each year. But on the other hand, I'm very good friends with her. But we've had a long, outstanding little tiff, she and I. And every time I go to New York, she makes me dinner. It's a crazy relationship. Barbara's an amazing real estate agent, as you know, and a very successful entrepreneur. But she's a very opinionated woman.
I've got just 3 ideas I want to pitch to you, so I assume you'll stay online with us afterwards, so I can.
I get pitched so much stuff. It's just, and I always say to people, look, don't pitch it to me, because the rules of the feds, this is the game show laws. If you pitch me something, you can't come on Shark Tank ever with that idea. And that's really a waste, because it might be a great idea. So I give them to my guy, Alex, who runs O'Leary Ventures. He vets them. He sends them to the producers. I have a deal called Prime 6. They came up with a better way to make charcoal. So give you an example. A chef, I also am a cook, and I'm a chef called Chef Wonderful on QVC. We have a big business in sous vide and in cakes and in desserts and things like that. So he knew this, and he came on Shark Tank with Prime 6 charcoal, and he took hardwood sawdust and compressed it into a charcoal bar, because he wanted consistent heat for grilling. This thing burns 3 times hotter, 3 times longer, and is a third the price on BTU basis. So I invested in that thing. It aired. They sold millions of they couldn't even fulfill the because people saw it, and they saw that, and I to put a video out cooking with it. I made a great pork dish with it. And Kroger's, out of the blue, called up and said, look, we want to roll this thing out nationally. There's a little company that was nothing that got exposure on Shark Tank, and it's blowing up. Like, it's just, husband, wife, chef team. Now we have the logistics challenges. We got to make millions of dollars with inventory. But that's the way it works. That's how the platform works.
What's the lead time from when you typically do a show, make a commitment, and then when it gets on the air?
It's about 4 to 6 months, so you get plenty of time for due diligence. We work closely with the producers. People tend to be extremely optimistic, and they should be, about presenting their opportunity. But we're not idiots. We've been doing this for decades now. We immediately we go to due diligence, and the worst thing you can do, I won't say lie, but is misrepresent your numbers. Everybody knows I'm a numbers guy. You can't misrepresent your numbers. And if we go and do due diligence and I find out that's the case, you're toast. So you got to be careful with your valuation. You got to be realistic. And other than that, most of the deals close.
Jeff and Brian, we're coming close to the end of the hour here. If you'd like to make a few kind of remarks to your guests, your audience. I know I've enjoyed this. Kevin, thank you very much for getting set up in Miami in time to do this. Kevin just got to Miami yesterday, set up everything. He said, I don't know if I can make it. He got it organized so he could be in his virtual studio, which is almost a real studio. But over to you, Jeff and Brian, for the wrap up.
Brian, go ahead. If you'd like to say something.
Yeah, just wanted to say Happy New Year to everyone. Thanks so much, Kevin, Connor, for helping us put this together. It was very helpful and certainly something different we like to offer to our clients. So thank you for that, and appreciate it.
Thank you very much. Take care.
Thanks, everyone. Thanks, Kevin. Thanks, Connor.
Thank you.
Thanks.